Now, I've always said the first rule of investing is don't lose money. And the second rule is don't forget the first one. And while that might sound like an old folksy saying from someone who drinks too much cherry Coke and reads too many annual reports, the truth is, after nearly 8 decades in the market, I've seen more smart people get into trouble. Not because they weren't intelligent, not because they didn't have enough capital, but because they forgot or ignored something very basic, that reducing risk early, before anything exciting happens, is not just good investing. It's the only way to make sure you're still standing 20, 30, 50 years down the line, and you see. Risk in the market isn't like a shadow hiding under your bed. It's not some mysterious force out there picking random victims. It's much simpler than that. Risk comes from not knowing what you're doing, from buying things you don't understand, or trusting people who are more interested in selling you a story than showing you the math. And believe me, I've been pitched more of those stories than I can count. But the funny thing is, the best investors, the ones whose names aren't splashed across magazines, but who quietly build fortunes that endure over generations, they don't chase trends or try to outsmart the market every year. They just start by protecting what they've got before they go looking for anything more. And I always remind people of that same old example. If you were planning to buy a farm, would you look at the latest farming trends on TikTok? Or would you walk the land, talk to the neighbors, look at the crop data, maybe check how often the area floods, because that's what any rational person would do. Yet so many folks treat stocks like lotto tickets instead of ownership in real businesses, but experienced investors, the ones I admire, they treat investing like owning farmland. They reduce risk up front by asking careful questions, by building in margins of safety, by saying no, a lot more than they say yes, because they know the biggest threat to their wealth rarely comes from outside. It comes when they get overconfident, when they forget that avoiding a bad loss is 10 times more valuable than chasing a big win. And if you're just getting started, or maybe you've had some success, but you're wondering how to protect it, then you're in exactly the right place. Because today I want to take you through how experienced investors lower their risk early. Not when trouble shows up on the headlines, but before they ever make a trade, by thinking slowly, planning defensively, and staying humble enough to know that fortune favors not the bold, but the prepared, and although that doesn't make for a thrilling news story. It's exactly what you need if you want to build wealth that doesn't just grow. It lasts. You see, most folks believe that investing is all about picking the right horse reading charts, or guessing which industry is going to boom next. But that's like thinking the key to winning a poker game is getting a good hand, when in reality, the best players fold more than they play. And that's exactly what experienced investors do. They reduce risk by knowing when not to act, when to pass, when to stay in cash and wait for a better pitch, because you don't have to swing at every offering the market throws your way. And in fact, I've said many times that the trick to investing is sitting there with the bat on your shoulder, waiting for that one pitch in your sweet spot, and here's how we do it. Not through luck or some secret algorithm, but by applying a handful of simple principles over and over again. First, we stick to what we know, what I call our circle of competence, because the market's a giant auction with all kinds of bright ideas flashing around the room. But if someone built a rocket and I can't understand how it turns a sustainable profit, I'm not buying one share, no matter how exciting the headlines look. And it was the same with dot-com stocks in the late 90s when people were throwing money at any company with a website, even if they had no earnings, no plan to get earnings, and heck, no product. But over at Berkshire, we stuck to what we understood, things like Coca-Cola, American Express, insurance railroads, because when we buy something, we want the economics to be so simple we could explain it to a fifth grader, and that naturally reduces our risk, not by changing the market, but by changing how we interact with the market. Which brings me to the second habit seasoned investors practice, buying at a good price, and I don't mean cheap in the on-sale clearance rack kind of way. I mean a price that builds in a margin of safety. Because just like a bridge is engineered to hold more weight than it ever should have, your investments should have built-in protection in case things go wrong, and believe me, things do go wrong. So imagine a great business like a farm that earns $100 a thousand a year, and someone offers it to you for $500 a thousand. That might be a fair deal. But if you can get it for $300 a thousand, now you've got cushion. And that cushion is where long-term wealth comes from. Not just from buying great investments, but from buying them at a price that protects you in a downturn. And the third thing we do to reduce risk early, long before anyone's talking about losses on CNBC, is thinking in decades, not quarters. Because the stock market is a voting machine in the short term and a weighing machine in the long term. So if you're trying to predict what a stock will do next Tuesday, you're gambling. But if you're evaluating how that business will operate in 2036 now, you're investing. And by stretching your time horizon, you immediately reduce the urge to chase trends, to panic sell, or to try and play the timing game, which is one of the surest ways to lose money fast. And speaking of time, the fourth big principle is letting compounding do the heavy lifting. Because most people overestimate what they can do in a year and underestimate what they can do with steady, low-risk investments over 30 years. And when you lower your risk, you allow compounding uninterrupted time to work its magic. Because if your portfolio crashes every 5 years, chasing high-risk trades, you're resetting the clock again and again. But the investor who grows slowly, safely, 5, 6, 7%, compounded every year, year after year, they end up miles ahead. And this idea of stability over excitement is one of those truths that doesn't make headlines, but quietly makes fortunes. And lastly, good investors reduce risk by surrounding themselves with people who think clearly, control their emotions, and value patience over prediction, because you could be the smartest person in the room. But if you're taking cues from the crowd, the market will hand you the same results it hands the crowd, usually mediocre ones at best. And that's why Charlie and I spent more time reading than trading, more time thinking than reacting, and more time holding than flipping. Because our goal wasn't to hit home runs. It was to stay in the game as long as possible. And when you look back over 50, 60, 70 years of investing, you notice something interesting. We didn't win by taking more risk. We won by taking fewer unnecessary ones. Now, what gets most people into trouble in investing isn't bad luck or bad timing. It's bad habits. Habits like chasing what's hot, trying to impress someone else, or assuming that just because something's gone up, it'll keep going up. And let me tell you, that's a dangerous mindset, because the market doesn't care who you are, how confident you feel, or how many followers you've got on social media. The market only pays those who respect risk. And the truth is, a lot of folks don't reduce risk early, not because they can't, but because they don't want to, because reducing risk doesn't feel fun, doesn't feel like winning in the short term. It sometimes feels like sitting on the sidelines, or like you're missing out. And that fear of missing out is one of the most expensive emotions in finance. It's what drives people into overpriced tech stocks, meme stocks, crypto fads, over-leveraged real estate, and just about every bubble we've seen in the last century. And the funny thing about bubbles is you don't know they are bubbles. When you're in them, they feel like smart investing until they pop. And then all that excitement turns into panic selling, and the mistake there isn't just that people lose once. The mistake is they weren't prepared to survive over time because they didn't build in downside protection before they started, didn't understand what they were buying, or worse, took on risks so subtle they didn't even recognize it, like margin debt, which I always warn against unless you enjoy watching your fortunes melt faster than a vanilla cone on a Nebraska sidewalk in July. And I've seen smart people get wiped out by using borrowed money to buy stocks. They barely understood trying to double their gains faster, ignoring that it equally doubles their losses. And here's another mistake people make. They confuse volatility with risk, which is like confusing weather with climate. Just because something goes up and down on a screen doesn't make it risky. What is risky is buying weak businesses, or expensive ones, or owning something you'd panic over if it dropped 20%. And that's why Charlie and I always said, we only want to own what we'd be perfectly happy holding if the market shut down for 10 years. Because if you wouldn't be comfortable holding it in silence with no price updates, you probably don't understand it well enough to hold it at all. And while we're at it, let me touch on something people really don't like hearing these days. Fast money is almost always fragile money, meaning if your goal is to double your money in a year, you're either planning to get very lucky or very reckless, and most of the time it ends with someone else holding the bag, which brings me to one of the biggest mistakes, believing you're smarter than the market. Instead of respecting it, listening to it, and most importantly, learning from your own emotional responses to it. Because investing is just as much about temperament as it is about analysis. And most people don't lose money because they picked the wrong stock. They lose because they couldn't sit still or couldn't stay humble or needed to prove something to somebody else. And so much of that stems from confusing activity with progress, thinking that doing more means doing better, when in fact, some of the most profitable moves we've ever made at Berkshire involve doing absolutely nothing, just holding steady while everyone else ran around in a frenzy. And the last pitfall I'll mention is one that's cost investors billions over the years, refusing to admit when you're wrong and doubling down on a loser out of pride. Instead of stepping back and realizing that good investing isn't about being right all the time, it's about making fewer big mistakes, keeping your emotions in check, and staying in the game long enough to benefit from the natural course of compounding, which can only work if you don't blow yourself up trying to be clever. And to sum it up real simple, if the game is to stay alive and grow steady, then the mistake is playing like you're in a sprint when you're actually in a marathon, where durability, not speed, wins every single time. Now, there's one thing I hope sticks with you after everything we've talked about. It's this: investing isn't about being the smartest. It's about being the most sensible. That reducing risk early doesn't mean giving up on returns. It means protecting the base so the returns actually have a chance to grow steadily without being eaten alive by one big mistake. And you'd be surprised how far that mindset alone can take you. Because most people never slow down long enough to realize that the real game is about staying in the game. And the irony is that getting rich slowly, methodically, patiently, safely, is actually a much faster path to lasting success than trying to get rich quickly and falling into the same holes people have been falling into for centuries, and the folks who do win over the long term. The experienced investors we're talking about today, they aren't magicians or oracles or daredevils. They're just folks who don't break the rules that matter, who skip what's popular in favor of what's prudent, and who build their strategy around protecting downside first because they know the upside takes care of itself when you've got time, when you've avoided ruin, and when you've allowed compounding to do what compounding does best. And let me tell you, and I've lived long enough to see it again and again, success in investing is not this fireworks show of genius bets and thrilling trades. It's more like watching paint dry or grass grow if you're doing it right. Because building wealth is like planting an oak tree. You don't dig it up every week to check on it. You plant it in good soil. Water it, protect it from storms, and let time do the rest. And that good soil I'm talking about, that's your discipline, your margin of safety, your patience, your refusal to confuse activity for progress or noise for insight. And when the storms come, which they always do, you won't be the one selling at the bottom or scrambling for cover. You'll be the one standing steady ready, and wise enough to know that staying calm when others are panicking isn't a gift. It's a learned skill, and it starts with how you think before the trouble hits, not how you react to it after. So if you remember anything from all this, let it be that reducing risk early is not small thinking. It's smart thinking. It's the decision to say, I'd rather have steady progress than borrowed thrills. And I'd rather be rich than look clever. And I'd rather survive than swing for the fences and strike out. Because avoiding the big mistakes over and over again is how we've built Berkshire into what it is. Not by chasing trends, but by sticking to principles. And the good news is that anyone can do this, no matter your income background or age. Start with what you understand. Build a margin of safety into everything you buy. Think in decades instead of days. Avoid leverage. Say no to things outside your circle of competence. And above all, never forget that boring investing is often the most effective kind, because the excitement doesn't come from checking your portfolio every morning. It comes decades later when you look up one day and see that slow, careful, risk-aware investing did far more than your instincts ever would have believed, not because you outsmarted the market, but because you respected it, planned ahead, and took care of your capital like a farmer takes care of his land, watchful, patient. Never in a hurry, always thinking about how to pass it down stronger than he found it.